Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Welcome, everyone. This is Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com. Very, very happy that I could be joined by Jason. So Jason invited me in Monday for his show, Monday morning, way early. And Hans this afternoon had to take an exit for a family affair. And I basically asked Jason if he would like to come in and share his market structure views, since we obviously have Fed Day today, monthly at the end of Friday, quarterly, which is a big one at the end of the month, and then of course reciprocal tariffs hitting April 2nd. And he said sure. So I'm so grateful, Jason. Thank you so much. And to give folks a little bit background on Jason, he has a Twitter handle, Wizard of Ops. He also runs a newsletter. He's an RIA. He runs a fund. I've actually stalked him because he's frequently on the Schwab network for his appearances. And last but not least, he's got tools. He's got quant tools. I would say you're a geek and you put together some really great geek tools. So we're talking with a quant and RIA and just general great guy who shared his thoughts about 5780 Monday morning, and we came really close today. So give us your thoughts. I get a chance to interview. Yes, exactly. So share your spiel here, what you saw and where we go from here, because this was Monday morning and now we're, the day is done, the week is over. Let's hit it. What do you see? And yes, and of course, this is also a Q&A format, Jason. So if we get some questions, Zoom Q&A, hit us up. We'll be happy to answer as we go through.
Yeah, that'd be great. Hello, everybody. My name is Jason DiLorenzo, the Wizard of Ops. It's a pleasure to be here and to kind of show you how we look at the markets and option positioning and stuff like that. First, I just want to introduce, this is Vol.Land, www.Vol.Land. And what we do is we are an option dealer positioning service, but not like any other one, because what we do is we consume the whole Oprah data feed. We have a calculation, a fair price calculation that's similar to what the CBOE uses. And to determine on which side of that fair price calculation, that helps us determine if dealers or customers own the option on every single trade that's executed in the day for 240 equities, ETFs, indices, that kind of stuff. And that's our methodology. We also have some comparative analysis to open close data as well. So as far as calculation go, or as far as categorization goes, I have not yet found any kind of data set that's more thorough than we are. That being said, what we do then with that information, with this net open interest information that we've developed ourselves, is we convert that into all the first and second order Greeks. So the dealer book on Delta, Gamma, Vega, Vanna, Vama, Charm, and Rho. Okay. And so the positioning across. And that helps you determine how dealers are hedging and also how customers are positioned for certain events like FOMC or Trump speaking or whatever. You can see how people are hedged and how people feel about the current macro situation. So Samantha, do you have any questions about kind of like that quick rundown of what we do? And then I could talk a little bit about our studies that we've done to kind of tell you what to look for in our database. And then I'll show you what I saw.
Yeah, so I definitely want to know the aggregate, because this to me is most interesting. Are they, buying or selling puts relative to buying and selling calls? I like to look at the quant flows, not just what, the big funds are doing, which you can kind of track a Nomura type of play of CTAs, long or short, risk parity, vol control. You're giving tools that help, I don't want to say day traders, but those who have obviously event risk that they're planning. Like last week, we actually talked about this. VIX peaked on the 10th. I actually warned clients the IV would be falling into VIX expiration this week. So take care of your SPY puts, etc. So that's the kind of stuff that I generally follow, but I'm a solid generalist, right? I really am. Macro, intermarket, technical. We talked about that, and quant. So you're more focused on the quant, and how do folks use these tools? In other words, how did you see for today's positioning? What do you see for Friday? What do you see for end of quarter? And then show us with the charts so we can understand, please.
Absolutely. So the first thing to note is, even though the popular chatter is more about gamma positioning, through our studies, we found that the most important positioning is in Vanna. And the reason why is because dealers religiously delta hedge. You know, this through our research, we know that dealers religiously delta hedge and they gamma hedge in a certain way. They don't always gamma hedge, they just sometimes gamma hedge. But what they don't hedge very much is Vega, implied volatility exposure. And so when their Vegas decline, as they normally do, they decay over time, then that will translate into deltas, and the measurement of that is Vanna. So our Vanna calculations are a leading indicator on a swing basis. We see moves that happen about 2 to 6 weeks in advance based on implied volatility moves. Over these past several weeks, we have had more exciting kind of Vanna movements because implied volatility has been going kind of crazy, right? So that's kind of the short story of what we see. So I'm going to kind of start from a Vanna standpoint and show how we saw 5680 as a critical area, and now I guess 5675 we've closed there, and so it's undetermined whether we're gonna the jury's still out. We still have a war to fight.
And I'm going to show you how I came up with 5676.16 before we moved down to 55.53.10, and it's totally unrelated to your tool. So that's why I'm also very curious how my system compares, because I'm just very curious. Okay, so go ahead.
Yeah. So the first thing I'm going to call out is this widget right here. So as you can see, our platform is widget based. You can manipulate a lot of Greeks, puts and calls only, stuff like that. This is a historical look at what the aggregate Vanna was for SPX going back 6 months. Now, of course, this a little bit has to do with vol regimes and stuff. But if, I don't have it plotted on here, but as you see Vanna increasing, not too long thereafter, you see the market increasing. As you see Vanna coming down, and not too long thereafter, the market comes down. So, and the average here is about 7.1 billion. If we stay in that zone, like right here, then you'll probably see market kind of just staying still, right? Not going too far. This is a good time for your short gamma, or, a little bit after this time would be a good time for your short gamma move, right? All right. So right now, what we're seeing here toward now is an aggregate Vanna that is positive and at or above average, right? And this increase right here kind of showed me, after a decrease back here, this increase showed me that we were going to bounce eventually. I mean, I didn't think we'd hit 55.10 or whatever we hit. I thought it would kind of stop at around 5,700, 5650. But then from there, I figured we were going to bounce. There's a lot of puts getting bought and a lot of support in the market from dealer hedging. So this is kind of just where to start. And you see, if I go here to puts only, these green bars here represent puts that are out of the money that are short for the dealers, hence customers buying puts, buying their hedges. And so when you see these green bars here, as implied volatility comes down, which is normally what it does, the dealers' deltas are reduced. Dealers have a lot of positive deltas that they have negative hedges against. And those negative hedges get unwound slowly as time goes on when you see these green bars right here. Do you understand that? Samantha, am I following? Okay, good.
Yes,
so
yes,
that's in a nutshell. That's how to use this, right? And these levels right here, 5650 and then 5680, which I'll show you on a gamma level, because at the price, when you're on the money, see right here, this very large gamma area right here, which was a sold call, is 5675 and 5680. This is starting to be kind of a resistance. And if you blow past that, then you would be able to kind of accelerate up to 5900 pretty quickly, actually. So, and this on the gamma, because Vanna at the money is always 0. We could talk a little bit. I mean, you could go on my YouTube channel. I could talk a little bit about Vanna and how it behaves, how it flips sign as price goes next to it, and why. So that might be a little bit too quanty for this.
But no, some will understand this very, very quickly. They're in this world. But how do most of those who are using this, kind of looking at the prices also on this. You got some institutional purposes. Are they playing the same 2 to 6 week time frame using mostly futures, options on equities? How do you think most are kind of leveraging this data?
So I think a lot of this data, we have some institutions, we have some retail people, and really this data can be used on a zero DTE basis. We have zero DTE charm. Well, now zero DTE is off, so I have to manually do this. But we have some zero DTE applications. But typically, the largest impact is time on zero DTE because time's ticking, right? So when we have some zero DTE applications. A lot of retail likes to use it for zero DTE, but you would need quicker updates, which, we usually suggest for people because our pricing is high, but it's mainly because we have to ingest all this stuff really fast, right? I guess now I think we're averaging almost 60 million options traded every day, and we're consuming them all. So what I always suggest to retail who like zero DTE, and that's primarily how retail uses it, is get to know, just join basic. We have historicals on here that are applied every half hour. You can get to, learn how to read it, look at how the market acts at certain times in certain regimes on zero DTE. We have an educational YouTube and an LMS coming out soon on Vol.Land, learning management system, and that will help you learn. We're trying to speed up the learning curve here. It is novel.
Okay, so how do you use this for your fund as it relates to, because you're an RIA, you manage money,
Yep.
You're using your own tools.
Yep.
So you've cooked up your own recipe, you're applying it, you're eating your own food.
Right.
How do you use this in placing your trades for your fund?
So we have 3 separate strategies in my fund. The one that I manage, and it's the one that I feel most comfortable with, is I like to do swing trades around 2 to 6 weeks.
We talked about
And
that.
I use primarily options. So I do like option structures, butterflies, delta butterflies, I call them, which is just kind of like a butterfly, but not centered, calendars, verticals, both short gamma and long gamma. It's mostly discretionary based on Vol.Land data. Our second strategy is we do have a zero DTE strategy where our trader combines the use of order flow and Vol.Land. And the way he uses it, because Vol.Land shows you where dealers have to act, whether positive or negatively, he uses it to forecast what will happen on the order flow. And that's how he trades. And he's very successful. He's very good at it. And our third, which is actually a fan of yours, Samantha, our third trader does individual equity swing trading. So she's also kind of like a 2 to 6 weeks, but she does it on the individual equities. I am pretty much on SPX. And yeah, so we've actually, the fund is pretty new. We've just started, but year to date, we are, I'm sorry.
But you're not focused on futures, long story short.
Our zero DTE trader trades exclusively futures on ES using SPX here. We are releasing futures in Vol.Land. We're kind of rolling it out right now. We have just the end of month options. We are trying to get the data flows from CME to get all the interim, and then we'll start advertising it stronger.
I know it's a new fund and everything, but I did want to hear that. You were about to talk about returns. Apologies for interrupting.
No, it's fine. Our returns right now, year to date, are 2.16% positive. And
with an S&P that's down 10%, NASDAQ down 15%. So very nice.
Yeah, right now S&P is down 5.1 and our Sharpe ratio is 2.2 right now. So we are, again, with an S&P that's down, I guess now like 5.5%, 6% from its highs. So, and it's like about 3% for the year. We've, our fund, it's new, but we're doing really well. We're actually very excited about how our fund has gone. And that's all unlevered too. We were just testing and making sure that we, before we levered up, that we got all the risks and, exposed all the risks, and the market helped us out with that.
It's fascinating. Obviously, you've got tools, you've got a fund. I know you do a newsletter as well. And you had actually brought me in. We were talking a little bit more of the macro backdrop. So for those who are joining, looking for a summary here on Fed Day, not that you care, Jason.
Oh, no, I care. But
but it is kind of market moving in the interim. see how the end of the week goes, but that's what I wanted to talk with you about. So the decisions around how the market, how the dealers are going to react to a hawkish or a dovish Fed, and came in as expected, no cuts, but the SEP, which is the forward dot plot, came in really as expected. No additional rate cuts need to be pulled out, even if the betting market is that there will be more cuts. Anyway, long story short, the biggest kind of change was their downgrade in economic growth and their bullish backdrop for inflation because of tariffs and trade wars. So it's kind of a mixed bet as it relates to, we had that kind of reflexive bounce, and then we sold off toward the end, and we filled some gaps on the hourly, which basically had been made 2 days ago. So we're really just flat with 2 days ago. But folks get excited because it starts to move aggressively. My observation, since I run a live trading room in the morning, and then I do the 2 to 3 during the FOMC release and the Powell presser at 2:30, is that even though the market was bouncing into that level that I had just, given before we roll over, my humble opinion, gold wasn't buying it. It was very firm. Dollar yields down, dollar yen down. So it was very much, they didn't believe it. Long story short, this is such a big deal for the Fed to taper their quantitative tightening. They didn't announce a pause, which would have been very bullish,
Right.
with a lot of follow through, 5 billion tapering, but they did announced tapering. That was the dovish part, even though the rest kind of stayed the same. And the fact that they're really looking at economic hit or concerns, not just uncertainty, but literally downgrading economic growth. So that all came together for this, what would have normally been, oh, well, they're doing a tapering of QT. They must not be really confident about the economy. The market should sell off. And that's exactly how yields responded with gold moving higher, but it didn't matter. Dollar yen falling, which has been very bearish equities, didn't matter because this reflexive move for Fed today was bullish into that 56.80, which you had given Monday morning. What do you see now for Friday? Because typically the more durable move happens after today's Fed day. So tomorrow we get jobless claims. 8:30 in the morning, and they've been starting to tick higher, even if unemployment is only at 4.1%. But after that, we tend to get Friday shenanigans with OPEX, and then the quarterly is a big quarterly roll. Show us what you've got for those 2 dates in particular, Friday and then quarterly end with the JP Morgan caller, etc.
Yeah, sure. So the first thing to note is I do care about the fundamentals, but the way I look at things is almost more like a game theory kind of thing. It's more about what do people expect to happen, because the Fed has actually been pretty good at communicating what will happen, but what do people expect? How are people positioned? And then what are the results of what something like FOMC would do to the market overall? And if people are positioned with a lot of puts and they're buying, they're hedging, I kind of always say hedging is bullish, selling is bearish. And so when people are hedging and then the dealers apply their hedges, so there's a long portfolio that have puts bought on it. And when customers hedge, they can both buy more, because they can lever up if they hedge like that. Especially if you have portfolio margin, which all the big customers do, right? Or they can just kind of save their portfolio going down. And I think when the market started correcting, they were just saving their portfolio. Now the dealers have a lot of these negative hedges on, right? Because they are positive deltas, and they have a lot of these negative hedges using ES futures. That's going to have to scale down as implied volatility comes down. The implied volatility of an expired option is always 0. So it always has to kind of come down, and that's how the dealers are going to hedge their book. As long as we kind of stayed above this 56.75, 56.80 kind of area, those hedges are going to come down very quickly. Or if we drop down to 56.50, they're going to have to actually sell more to hedge. So we are sitting right now, right on the tip of the triangle. And I think you're saying that we're going to tip bearish. Some people are saying we're going to tip bullish. We'll see which way we go now, because the way that the market closed pretty much right on where I saw our big Vanna node kind of, tomorrow can get a little bit whipsaw, especially in the pre-market. We could see some big green and some big red all at the same time. And so we're going to have to see which way we tip from here. What I see here, this is tomorrow's execution. Well, I guess this is next week. This is next week's. Let me include tomorrow, because tomorrow is mostly done, but a lot of the big OPEX moves are actually like Monday to Wednesday and then after OPEX. But let me Let me include the specific date range for just this next week so that everybody can.
Yeah, not everyone is a 0 DTE. And honestly, if you look at the levels, we're right back to where we were Tuesday. I mean, we have gone nowhere fast for a solid week. You know, how do you trade this when we're just in this kind of chop zone? And as you mentioned, you know, the hedges right above that. What'd you say? What was it?
56.50 is a big one.
56.50.
Yeah, this is basically, you could kind of almost look at this as a mountain to climb, right? This is the cumulative Vanna, and this, you know, this requires a mountain. Now, implied volatility will come down tomorrow, right? Because the OPEX implied volatility is going to come down. So as long as this is positive net, which it is right now of about 1.5 billion in notional in SPX, we will probably see a small march to the upside. We see 5,700 here as a little bit of a resistance, but if we can get over that, you know, we can slide pretty high. So the way I would play this is down here is very supportive. Unless we see implied volatility explode, especially next week, I could sell some put verticals up here, or when I have a forecast like yours, where you're going to say we're going to head down, I would put on a delta butterfly somewhere in this 57.25 area, maybe about 50 wide ending next week. You know, that's the term that you want to trade. And if we're going to look at the next 30 days, which is usually what I look at when I'm putting on new positions, right here, a lot of this we just saw is over the next week. So after the next week, then we might be able to see your bearish drop, because a lot of these puts are going to come off. So that's when it becomes more acute, more possible. I was kind of saying that the JPM collar, like it's 61.65, that would be the maximum at the end of the month. Don't think we'll reach that high. We'll probably not close anywhere near the collar unless we see a runaway, you know, bullish track. But you can see here, even 61.65, I have to zoom in to see that strike right now, right? It's not going to have as much of an impact as it usually does. So
how about
you
the
see,
lower
like everybody
put spread though? The lower put spread, which is
the
what,
lower
55?
put spread is 55.65, right?
Yeah.
That's right here. So if we pass 55.65, or we get down to there, that is not going to be it's not going to be as much of a magnet. We're either going to pass it and shoot way down, or it's going to act as support, and we're not going to get if it does approach it, it'll bounce very quickly. So that's why I say, like, I would sell kind of put verticals, and if I'm threatened, you know, like maybe 5,500, like you want to leave quite a bit of room here. 5,500, 5,450, something like that for the end of March, or even maybe a little afterward that you plan on pulling off. That might be good, but definitely, especially with Samantha's forecast that, you know, her cross market indicators are saying that we could head down really quickly through a different liquidity source. Remember, this is just dealers and customers. If we do realize that and we're not going to shoot up, I would do a delta butterfly up here, only because it's a lot less risk on your portfolio. Only apply maybe 0.5% of your portfolio, 50 bips of your portfolio on something like that, and it would return 2 to 3%. So that would be my strategy if I were applying new positions on now, which I'm not. I have my April positioning. It's kind of a Franken spread a little bit, but I have my April positioning that's kind of saying we could go up, but I would actually make a little bit of money if we head down. I would make a lot of money if we head up. That's kind of, and as long as we don't head up to like 60, like 62, 6,300, that's where my risk is. That's the risk I'm willing to accept.
By what date your 6,200 outlier event?
April expiration.
Okay. All right. So a little ways out. We have a question. Let me just ask if there is anyone who wants to hit us up. Definitely let us know. I've got Joe saying, do you guys go over the ODTE levels? Obviously, 0 DTE on a daily basis for the ES, number one. And two is, Jason, wow, impressive. How do you capture dark pool data?
Okay, so really quick, the first question. Every day I post on my Discord page 0 DTE updates. So kind of like 2 to 3 times a day. If it's like calm, it'll be like two times. Or if it's wild, it'll be like 4 or 5 times. I will post a 0 DTE update. And you can even get that in your text messages. So you can get a text message of my update. So if you're looking at your trading window and, you get buzzed, you could see, all right, this is what, I'm seeing, Wizard of Ops or whatever. You can see what I'm seeing. So yes, we give 0DT updates, and this updates in our live version of our platform every 5 minutes. This paradigm here, you kind of have to do, it's a little bit of our Vol.Land lexicon, but it gives you kind of a outlook on what the options look like for 0DTE. We also have a liquidity indicator based on the dealer spread between fair value and execution price. The wider that spread is, the more illiquid markets are, at least for the options market. But that does permeate through all the other markets. When it's illiquid in one, it's illiquid everywhere. This is the level of data that we have. What was the second question?
Oh, how do you get your dark pool data? How do you capture dark pool data?
Yeah,
I'm assuming it's more than just the SPX E-minis. I'm thinking it's a little bit more like equities. Do you also provide?
Yes. So every single option trade that's executed is in the Oprah database. It is not, it doesn't matter whether it's live or it lit or dark market. If there is, if you go on your Robinhood account and there's a PFOF, a payment for order flow transaction on your option, it is reported to Oprah. Okay. Over-the-counter derivatives is a separate issue, but dark pool, which is just off exchange transactions, do have to be reported to the Option Pricing Regulatory Authority, OPRA. So that is a requirement. So the dark pool data is included in.
All right. And a question, it says lots of dark pool flows around 5120, 5150-ish. Would you agree? What are the odds we undercut, this is obviously in time, not today, to 4850, which by the way, I do see as a major, massive support area if we were to get down there. Much of retail that has been buying hard this dip will be margin called, not to mention, other firms. So basically you got a very bearish outlook here. Do you see the dark pool flows all the way down to 5120, 4850?
Oh yeah. I mean, we see everything down to that level. I'll bring up that, and I will go to relative values, all expirations. So these are the deltas that we, that's calls only. Hold on, and puts in calls. So this is our delta kind of outlook. So this will give you the delta positioning for right now it's dealers, but it will, all you have to do is kind of flip it in your mind to see customers. And we see a lot of hedging here at 5650. You're looking at 5100, you said, this is actually a pretty strong delta for that far out of the money. That's probably puts
he's saying
that far out of the money.
Anonymous is saying 5120, 5150. So this is something that is obviously visible outside. In other words. Okay, so you're seeing that as also a solid support area. Anything below?
Yeah. I mean, this right here, 4,000 is actually it's a forwards trade, a little bit complex, but it's meant to capture, this is puts and calls on the same strike, and it is meant to capture the interest rate on the market. So you kind of have to discount this a little bit. Typically, if we were to fall beneath, like say this level here, 5,600, 5,500, believe it or not, institutions panic too. And we will start seeing a lot of these grow, not just because the deltas are increasing from gamma, but we would start to see a lot of puts bought, especially I think if we go below 5,500 right here.
So we're not there yet, long story short. For example, if I look at my technical analysis, I see massive support at 5265. So I don't know if that comes up in your radar for dark pool activity, but that would be a level that I think would get bought with both hands. Do you see anything down in that level? Should we, get there, let's say sometime in Q2?
In Q2, right now, typically when options are applied, when hedges are applied, there are several institutions. Some of them do it annually, and that would be in December timeframe where those options are. They're not going to have as much of an impact right now. Some are quarterly, like the JPM collar, sometimes at the end of the quarter and sometimes at OPEX. So right now, the April roll is a little bit bearish, but not very bearish, right? And by the end of March, it'll probably, or bearish, a little bit stronger bearish. So what we see are flows. We don't use technical analysis very much. I think if we were to get below 5,500 and prices of puts were to get very, very high, your level is probably a logical level where they would start buying puts and start seeing support between 5,200 and 5,300. That is a little bit game theory-ish, a little bit speculative, but that's what I would see. That's what I would want to see to support like a 5265 bottom in Q2.
Do you track the VIX activity closely? I know you can, but do you?
Yeah. So first of all, we do have our own VIX calculation that we use the CBOE calculation, but we apply it to every single equity we have. So, VIX, as you know, is just SPX. But if you wanted to know what the VIX is of Meta or Tesla or something like that, all you have to do, we have a statistic here. We track that for all of them. Here, we'll see Tesla. The Tesla VIX is 77.6. It's a little bit more than SPX. What we do is we're a little bit more, I don't want to say quantity, but we're kind of what we
You're
pay
very
attention
quantity,
to.
Jason.
We're quantity, okay. But we pay attention to spot vol correlation. That is the core of what the dealer hedging, when VIX goes up and SPX goes down, this is the expectation from the dealers and how they price the ratio of that correlation. You can see this is the daily change. On the x-axis is the daily change of SPX, and on the y-axis is the daily VIX point change. So you can see it's very correlated. It's not random when VIX goes up and SPX comes down. It's inversely correlated. The thesis was that this is because VIX is, people are buying more puts as price is going down, and people are, selling calls or something as price is going up. And we found that it's mainly based on dealer Vega exposure is what causes this. What we pay attention to is VIX overreacting to this relationship, or is VIX underreacting to this relationship? And if it's overreacting, that means liquidity is bad and a lot of participants are buying puts, which is a hedging activity. And, we have a study of, which says that if you over VIX, which is 2 points above the implied slope here, 2 points above that, if you over VIX, we will return to the day before's closing value within 3 weeks. That signal has succeeded 18 out of 19 times since 2013.
Good odds.
Yeah, it works out very well. And we over VIXed on March 10th, which means that 5770 is the target, because that was the day before. So we over VIXed on Monday. We should hit 5770 by the end of March. Or we have another fail. We have a second failed signal.
So by
it is
end
a weak
of March,
signal, but still we can
so
by end of March,
5770 between now and
5770
then,
again.
but it could be at any day. You don't
That's right.
care as long as it tags, and then it could reverse.
That's correct. And sometimes it tags, and it is SPX, so it does have to tag during market hours. That's the way the study was.
I love that. Regular trading hours really, for me too. It's like if it does it after or pre, I'm like, give it a time. It isn't a question of if, it's just when. It has to hit RTH. So we're in agreement there. A question, what sectors do you see most flows? Do you actually track sector rotation growth versus value, for example? Someone's asking on a relative basis. Energy seems interesting, lots of bearish flow. Talk about oil. What about consumer discretionary? In other words, how do you identify sector rotation for use in, I have my own system for growth value for sure, but as it relates to your quant tools. And what about Mag 7 that have become more the Mag 7 lately, which is that what I love about growth value rotation for me, this is the cat's meow, because those Mag 7 plays are beautiful layups short when we get a rotation into defensives. And when we get a rotation into, let's call it low vol, the high beta stocks that have been selling off, and low beta has been absolutely rallying. So you got a 14% pullback a few days ago in high beta, and a plus 2% in low. That's just a gorgeous setup for short at will, the growth plays. But now they're bottoming. Now they don't have the same type of, in other words, a lot of their rotation has already kind of been unwound, and now they're trying to catch their breath. So how do you find that rotation in your tools?
So a lot of what we do, we focus completely on like what the options outlook is, but there are a lot of institutions that focus on rotations, and they buy options speculatively in order to identify those rotations. So, I mean, if somebody said something about utilities, was that, or this is oil?
No, consumer discretionary, oil, basically, if you see any flows into sectors when you're getting this type of concentration risk defined.
Yeah, I mean, out of our 240 tickers, we picked those tickers based on option flow. So, I mean, if there's a lot of option flow, because that's when we can indicate our best. Mag 7, top 7 stocks, right?
Yeah,
That's, when the Mag 7 on options are the top 7 stocks. Other than Tesla, Tesla tends to have a mind of its own. There's a lot of in and out every day in Tesla. I don't want to say manipulation because that's kind of a dirty word, but there's a lot of intraday trading. How's that in Tesla to try to, and you can almost see it in Vol.Land if you have a, the live subscription, you can see it going up and going down and going, you could see Tesla following the options flow. But, when you see something like oil, you would kind of have to put side by side. You could put the oil charts right next to whatever other chart you were looking at, natural gas or something.
XLE or most likely.
XLE, yeah. Let me see if XLE, I think has.
Yeah, the XLE is very liquid. Also, another one about XHB, which is home builders. If you kind of show those two sectors.
I don't know if that's the XHB is in there now. Yeah, we'd have to. I mean, here's the next thing. We consume every
XLF. Use one of those. XLF, XLE.
Oh, XLF definitely we have. Hold on. That's financials, right?
Yep.
Yeah. So right now with financials, what we see, this is puts and calls and Vanna. Oh, that's interesting. So they are hedging pretty heavily. Oh no, it's XLF 49.56 right now? Or did they just go through
49.56 sounds good. Yep.
There we go. Yeah. So right now what we have on XLF is, so this is interesting. They are selling calls to hedge their books. So this is usually done to capture an interest rate that is inherent in the options. People don't want to buy puts because they don't want to be negative carry. They want to be positive carry. So they sell calls. What that does is it does kind of drag the market up a little bit. But if there is any negative catalyst, any bank related thing, it's going down and it's going down hard. We saw that in February, right before the February OPEX. We saw nobody was buying puts. Puts were so underpriced to the point where people started saying we were selling puts, and they weren't selling puts, but nobody was buying them. So they were so underpriced that it left the door wide open for a drop. And we were in the money calls, we were, here on XLF, it would be the equivalent of being up here in like the 53 range. That's where we were located. And we knew that as soon as February OPEX came off, we were in deep danger, even if it didn't happen like right the day after, even though it did.
When did you see this? Because it just so happens that I run a live trading room, right? So literally on March 3rd, I saw a massive 52 by 50 put spread come in for March expiry. So we hit that and it was down to 50, like within a New York minute. It took like 2.5 days, which is unusual, but clearly they came in, they were selling calls, they were buying put spreads on March 3rd, and then it immediately started collapsing. So
what we would see,
what you saw,
what would we see, and what we would say in that, when you saw like a big put spread, sold calls in order to finance it, right? If you sell off right after that transaction, what that is saying is the institution that owns that portfolio, which has to be big, the institution that owns that portfolio is hedging an existing portfolio. They are not levering up. So that is a bearish signal right away. They're hedging and they're not
selling, they're hedging, not selling.
They're not buying anymore. So
correct. What did you see with yours? That's what I'm trying to say with the XLF, because it goes back a little bit, and then you're saying right now they're still selling calls, so they're still hedging. They're not, like you said, hedging is bullish, selling is bearish. You're telling me that they're really more likely hedging than selling outright.
Yeah, they're hedging, selling calls. They're not selling XLF, but as soon as XLF has some kind of negative catalyst or something that you see, you're going to want to see puts being bought, because right now there are only small puts here.
But you also have the underlying where they could go and deal with JP Morgan directly, or Berkshire Hathaway, or Bank of America. So they could go to the Visa, MasterCard. Those are the big weightings, or the top 5. So they could actually be playing the individual as well as the ETF.
Yes. Yeah, we see a lot of dispersion as well. You can see here JPM has a lot of traffic as well. Yeah, we see a lot of dispersion in that sense too. We have Bank of America, we have JPM, we have like the big banks. They have a lot of what we see here. This is sold call, it looks like, which is bearish. That's people getting too bullish, right? Yeah, so those are sold puts right there.
Where?
That's probably what big spread is at 230 here on JPM. I would expect the market pull back pretty quickly back to 230 here in JPM. And then if it passes 225, you're going to want to see puts getting bought. This is this is
that's
not
an
very
easy one
supportive.
though. You know why? That's the 200-day. So JP Morgan literally on 218 made its last high, and 219 rolled over, which ironically is when I started to see the breadth and the net selling come in and warned clients before we had the Friday, February 21st sell-off, and then we obviously dropped from there. But JP Morgan went all the way down to its 200-day. I mean, we're talking about a high of 280 down to a low of 224. That's a massive move in a very short period of time. So to retest the 200-day around that level that you're talking about is usual. Like it usually does that snaking action. It'll retest where it's already been. The question is, will it break?
Yep, that's the question. And right now, I would argue, yes, it would break. To sell the 230s, it would break and you would probably get some momentum. You would want to see puts getting bought. This is an aggressively bullish option, from customer standpoint, an aggressively bullish option look. We have puts getting sold and calls getting sold. So probably the way I would play this with options would be to sell call verticals, because you don't know if they're going to necessarily push it down. You don't want to be that guy who's standing on the train tracks hoping the train will stop as it gets closer. So if I sold a call vertical, it would probably be in this range right here, 255, 260, this kind of area, because this right here is strong resistance. JPM, this look right here, you have to climb up a mountain in order to go up. Yeah, I don't see it reaching like kind of this area right here. And if we do drop and we drop hard, then you would realize your full gain.
But you're talking about by April monthly expiration or April 30th? Like, what is your time frame as you're kind of sizing this up? Because time frame matters, direction matters.
I would probably do this. Yeah, I'd probably do this for the April OPEX, only because that's good timing. Kind of, you're going to get a lot of premium. And if we do drop and we drop hard, you're going to realize all that premium pretty quickly. And you could just, I like to say you always have to pay your lunch money, because you never know if you're going to bounce and start violating bad things. So pay your lunch money, but, go have a stake. Yeah.
So the views right now, because again, when we were talking Monday morning, it was, a bigger picture of macro, why bullish, why bearish. We've sold off a lot. And yet we still have the April 2nd reciprocal tariffs that are to be deployed. Some people don't think they're going to happen. I personally do. They might be pushed out. But for right now, do you see any concentration around that April 2nd implementation date of Trump's tariffs, reciprocal tariffs? Noteworthy about, in other words, is it sell the rumor, buy the news of tariffs? Is there, in other words, that second, is there any kind of importance around that date?
So here's what I see, and it's kind of it's interesting, because I've been, I obviously I look at this all the time, but starting April 1st right here, I read the news too. I know, April 2nd is a big day, and it flows March 31st is a big day. So starting after March 31st, there is some hedging here, but not like a ton. And that's kind of why I think we might be, this is a little bit supportive, but if we drop, if implied volatility expands, then this can be a pretty strong downside move. But right now, I'm seeing that there is a little bit of support. If we get down below this area right here, this 5,600 area, it can run pretty quickly to 5,500, and that's when I would expect to see more support here. If I look here at just puts, I want to see if these are puts or people are buying calls. And that's interesting. So it seems like there's a lot of call buying. So in SPX, now typically call buying is not necessarily even bullish. It's maybe trying to recapture certain gains, recapture certain losses or something like that. This right here for calls is quite bearish, actually, because there's not going to be here. If you see a big negative strike right here, like we see here at 6,000, that's somebody buying calls there, a large call strike. And that's usually actually bearish. It's kind of hedging a bearish kind of outlook. Okay. So somebody probably shorted some ES and applied calls here at 6,000. We see that here too in the 5,700 region. So this is not very bullish after March 31st into April 2nd.
So this is helpful, right? So I'm I'm an if then trying to look at where are the levels that I'm looking for. I think 5,600, the E-mini in particular, is also a line in the sand with Fed liquidity. And I know that Jay, who was on that call with us Monday morning, is very focused on Fed liquidity. So we're really on this kind of critical support level. And I very much expect at least 55, 53 within the next, few days next week. But after that, where to? So that's just a bounce. That's just we have to, retest. But if we take that out, then we have some lower levels to come in. And obviously the dates are end of the quarter into April 2nd. And I'm curious what your kind of the dealer customer tug of war says about positioning into the start of Q1. And so right now you're saying it does look more bearish than bullish. Long story short, keep your hedges.
Yeah, I would keep your hedges. I would not risk a ton. Like right here, the big fulcrum between, the March 30, this right here, I guess would be you said April 2nd time frame. That would be the big fulcrum here is 55.65. That's the JPM collar.
Yeah.
So this is the big area after March 31st. That's when I would want to see where we're at. I personally, what I see is I think we do hit 57.70 kind of area before March 31st. It's only 100 points away. And that's, a week and a half, 2 weeks, I guess, of time there. I think we do hit it. Once we do hit that area, all bets are off. We can, 5,800 to the 57.70 to 5,800 area. I would want to see if we blow past that, then 6,000 is the huge strike that we saw before, right here.
Yeah.
This strike right here.
But that's a big if. Okay. So that's an if then. And your time frame for that though is when?
So 57.70, 5,800 area should be before the end of March. Then once we hit that, then I would, it will probably do nothing for a little while, kind of meander between, we'd have to get past up 5,800 in order to get really bullish. But if we do get past 5,800, you can get up to 5,900, but it would be a slow crawl and we'd bounce around, be a good time for a condor. And if the macro plays out, if the macro flows play out that you're saying, I would see support down here, like we hit 57.70, 5,800, and then we drop. I would see support down here at like the 5,600 and then 54.75 area, this area right here.
So you're not worried about lower than 54.75 area into the April 2nd is basically it in a nutshell. You don't see lower than that.
Yeah, I don't see lower than that, but it can come quick. Tariffs are executed and inflation expectations rage. IV will rage higher, right? Because you'll see bonds starting to go. All the markets will start to get illiquid. For me, the way I trade, if we get down to this area and we get south of 54.75, I would start to look for bullish, hints or macro things. I won't trade it right away. But once I see like kind of a little bit of a bullish turn, even in liquidity, if the Fed does something, whatever, then I'll say, okay, now's the time, then I'll buy. I usually buy after the bounce, not before the bounce. Why catch the falling knife, right? So I'll miss like a few points or whatever, but I'll be confident if there are puts bought, I'll revisit at that point.
Super. Thank you for the outlook, Jason. I really appreciate it. So this has been very helpful. We really did do options power hour. Very little macro, but this is important because the flows absolutely matter. We've talked about it for a while. The flea on the tail of the dog, it's moving everything now. The options of the dog. So we've got the flows that are coming in, and I have a thesis, which is basically we need a macro trigger to interrupt the bullish flows. And we have had bullish flows all of 2023, 2024, especially with coordinated policy intervention, where all three legs of the table, which was Fed, Treasury, and White House, were coordinated. And the allies were also coordinated. So it was a lot easier to kind of get bullish because of this expected intervention. Now, not so much. So we have a different dynamic, but we still have the option flow and the dealer customer, like you just said, kind of tug of war of dealing with where they're coming in and really buying or not hedging, which means selling. So you have a system that you're using, and I was curious about it because we started talking about it Monday morning. So today was very, very helpful. Tell us where folks can find you, because this is new to me, right? This Vol.Land and the fact that I know that you launched a fund. Congratulations. And
Thank you.
You are giving us some good levels and some things to keep in mind. And of course, your tool set, which is new for us. So that's why I really appreciate you pinch hitting for Hans, but also literally, you just came in like that. It was like effortless. Thank you so much. Where can folks
No
find
problem.
you, Jason?
www.Vol.Land is where you can find all this data. That's our dashboard. We do have a Discord room. The link is in my Twitter, Wizard of Ops. Yeah, join the Discord. We do have a free Discord room. We do have subscriber Discords as well, but there is a general Discord room where you can ask questions. For educational purposes, we do have a YouTube channel, which has a lot of, all the I was talking about with Vanna, all the Greeks, all that kind of stuff is on our YouTube channel. We have
because education.
And if you're interested in the fund,
education is education is very helpful, but your interpretation of this data, like some people do data really well, I do context. That's my kind of, so your context of interpreting this data is found mostly in your Discord, is that it? Or mostly on your site?
So how we read the data is, you can go on the Discord and find that. On Vol.Land, on the landing page, we do have a white paper that's a little bit outdated now. It's like 2 years old, but
it's still very good.
Old, but it's still relevant. And we show the correlations between the data that we have here and market movement, primarily on SPX. And so you could see like there is a strong correlation between what option dealers are doing and the movement of SPX. There's videos as well on YouTube if you don't like reading.
All right.
So if you like charts and stuff. So yeah.
All right. Well, this has been wonderful. Thanks for the macro to micro options power hour. Hans will be back next Wednesday. We'll definitely catch up with you again. Appreciate your insights into the end of the week, end of the month, and April 2nd. Terrifying tariffs. All right, everybody. Thanks again for your attention and time. Cheers. Bye.
All right. Take care.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.